Hey, everybody, and welcome to episode number 139 for the National Land Realty Podcast. My name is Mac Christian, and I'm the Chief Marketing Officer here at National Land Realty and the host for this podcast. Now, today, super special topic. We do this once per quarter. We sit down with Jackson Takach, who is the Chief Economist and Director of Strategy, Research, and Analytics at Farmland. If you're not familiar with Farmland, it's the secondary market for agricultural loans. Now, this is a super important program and super important topics that we cover. Now, in this episode, I'll be talking to Jackson about tariffs. We'll be talking about the big, beautiful bill. We talk about the farm bill, cattle prices, input prices, everything that relates to you and your land values. Sit back and enjoy. This is a terrific episode with a lot of terrific information. Thank you. Okay, and we are live, which means I have to stop picking my nose and everything here. So, I'm here with Jackson Takach, Chief Economist and Head of Strategy, Research, and Analytics at Farmland. If you are not familiar with Farmland, they're the place that supplies everything for ag loans. I mean, if I'm going to run it down, Jackson, if you want to give brief overhead on that, just so people know who you are, where you come from.
Yeah, sure thing, Mac. Thanks for having me back. Farmer Mac, it's a company I've served for almost 20 years, like unbelievably. I don't look like I could work for a company for 20 years. At least that's what I tell myself. I've been at Farmer Mac for 20 years. It's been a phenomenal company to work for, to watch grow. You nailed it. We're secondary market for ag mortgages. So we don't have any offices that a farmer walks into and says, hey, I'd like to get a loan to buy a piece of property or to refinance, a piece of property that I already have a loan on. Instead, we work lenders, right? So our customers are lenders who offer loans to farmers and ranchers. They sell those loans to us and they pass along savings, more efficient capital uses, different types of products. And it's a virtuous cycle of savings and better deals, more favorable terms, longer amortizations, 30-year fixed rates, all those kind of things farmers and ranchers have access to through their lenders from our programs and services. And it all happens kind of behind the scenes. Many farmers and ranchers maybe know who we are. Maybe they even have a loan with us. And many times it's completely transparent to them, that process, right? So it's all happening in the background. It's so efficient. Sometimes people don't even know that we're behind the scenes. We also have a really fantastic infrastructure program as well. If you think about all the stuff farmers need, they need data, they need power, they need all sorts of connectivity happens, and we help finance those projects as well to keep the cost of power, the cost of data, the connectivity from Internet of Things, right? You think the farm today is much more connected than it's ever been, and we're also helping to make that network of infrastructure finance more efficient and deeper in terms of capital availability. So that's us. Been around since the late 80s, and it is a phenomenal organization. We do a lot of really interesting things, a lot of irons in the fire. We're pushing technology. We're really pushing innovation out there in the space. And so, if you haven't heard of us, check us out.
Well, and I was going to say, so we talked briefly beforehand, and there's a few topics we're going to jump into. We're going to jump into some conversations about trade, some conversations about Farmer Mac has a new report coming out on farmland values. Those are all awesome. But I want to kind of, as you were talking, I was like, it kind of went through my head. So we didn't prep for this at all, and I'm just going to throw it at you. What's the old quote is, may you live in interesting times.
Yes.
I feel like right now is got to be one of the most exciting times you could be in as an economist. Like right now is, I don't know, like what are you doing to stay in tune to things? Like, are you just plugging yourself into, and we were joking about Twitter versus X before this, are you just like plugging into that thing all day to see what's happening? Or like, how do you keep tabs as, the economist for an organization that handles finances in one of the highest impact zones of our current, economic policies?
Yeah. I don't know if it's a quote. Yes, I think you said that right. It's a quote. Some people would say it's a curse, right? And may you live in interesting times. It's like, oh, no comfort, no quiet for you. And certainly today's environment is probably the most rapid fire set of news, new conditions, new data coming at all of us who are kind of watching this stuff happen. It's really happening in real time. And when you say it's exciting, you're absolutely right. It is. It's exciting to have sort of real-time policy experiments coming to the marketplace. And I look at game theory, right? There's a lot of game theory that's happening in the global political landscapes. There's certainly interesting things happening with supply and demand and shapes of demand curves and elasticities and all those things that you study when you're an economist. You study those back in undergrad and grad school, but you don't always get a chance to see them in real time. And you're exactly right. That's why it's exciting. But also with excitement can come, anxiety or trepidation or terror. And I'm not saying any of those things are true now, but the faster things go, the less certain you are sometimes about the absolute outcome. So I talk about the cone of uncertainty. And when you're making a decision or you're doing a piece of research and you're saying, hey, what's going to happen next year? When things are moving kind of slow, when there's less policy action, when there's fewer geopolitical ripples happening, you can kind of narrow in on cause and effect. You can say, hey, this is the likely next 12 months. And then the more you introduce in the way of change, the wider that possible set of outcomes becomes. I think that's what we're all reacting to as a profession. Economists are just basically saying, okay, well, here's what I thought 26 was going to look like. Now I think it's probably somewhere in here. Very similar. I always say when I talk to groups that economists are very similar to meteorologists that will sort of give you a general sense for where things are, but it might be 50%, right? 50% chance of rain. Okay, flip a coin. Is it going to rain or not? That we've had to sort of widen that. We're not 90% anymore. We're at 50% or 40% or 30% confidence. And so that's a little bit frustrating, creates anxiety to sort of say, hey, I've got to take in more information and I have to make predictions with less certainty. I hate that part of it. But I love seeing all of the live experimentation and proof points of different, positive and negative, of different economic theories that are really rolling right now in the world economy.
I was going to say from the role that you have, a lot of the pressure on economists gets put is that predictive modeling, right? Like what's going to happen next, and to your point exactly, where there's experimentation happening on a level that like we don't normally see, where it's like we kind of put our toes in, and if the water's hot, we take our toes out, and then people in your role have to go out and say, hey, remember all those predictions I made? They're all out the window now. They're gone. Yeah. We're starting over, and we have a new prediction, and then people from the consumer side, then you get the standpoint of like, well, you said this last week, and right. It's like you have to relay the communication of the whole policy changed. That changes everything. So I'm just predicting, like it's a funny situation for your role. I mean, do you have new news feeds on like an IV drip? Like, how does this work? Like, it's just like constant. Yeah.
That's basically it. So you ask, how do you keep tabs on everything? You have 1 million Google News alerts. You subscribe to every newspaper imaginable. So I subscribe to the Wall Street Journal, the New York Times. I do Apple News because you get a lot of other things with that. Washington Post, right? AgriPulse, I mean, you name it. We have a subscription to it in order to sort of take all of that signal and try to distill it into meaningful information and do your best, right, to sort of not miss things. I try to be forgiving of myself if I miss a news. Somebody sends me something, I'm like, I didn't see that, There's just a lot happening. So to try to keep up on everything, you kind of just give yourself a little bit of a pass. But I also it's like a giant airbag is just sitting under me. So if I make a prediction and it's way wrong, all of a sudden I just can say, oh, well, it was crazy, right? Like we were doing a lot of different policy things. We're doing a lot of legislative things. The world was reacting. So of course I'm wrong. Yeah, of course. Like, come on. I can't be right about everything.
Well, and so let's get into it a little bit. One of the biggest pieces of conversation over the last 3 months has been trade. I mean, that is the overwhelming news headline to rule all news headlines, and it's changed as we've communicated, right? And even as you and I are talking, there could be a change in policy. Let's talk about sort of where we are and sort of what's happened. And sort of what you're seeing. We started out with a couple of tariffs, and then we ended up with a lot of tariffs, and then we pulled back on some tariffs, and now we're in the process of mid-range to the same tariffs to some lower and some higher.
I mean, that's I couldn't have said it better myself, Mac. That was the perfect recap of the last 60 days, roughly. I mean, it was we knew, right? So campaign trail, President Trump goes out and says, "Hey, you guys know this about me, right? I like to make deals. I think in some ways we're not being treated fairly on a global trade, relationship level." And so he's got advisors, Peter Navarro being one of them, who says, the way to fix that is to, put some taxes on goods coming in, and then they'll react, right? They'll either do what you want, or we'll buy less of their stuff. Either way, we're supporting the local economy, and we're raising tax revenue. So that's the theory. That's the thesis that the president came into office with and delivered, I think, exactly what he said he was going to deliver, which was we're going to raise tariffs and we're going to look at who's treating us fairly, right? Fairly in air quotes, just because everyone has a different there is no objective fairness when it comes to trade. There are perfectly good, valid reasons that countries place taxes and tariffs on incoming goods, and there's punitive reasons for it as well, which I would consider sort of less good, less objectively good.
Right.
So
there's a lot to sort through as far as some of it's logistical, some of it is punitive, and some of it's doing the same thing that we're talking about, where you're trying to promote domestic product versus imported product.
Exactly. So you got the president comes to office and he says this is why we're doing it. Comes out, I think, on Liberation Day, right? So that was the name. It's not my name for it, right? That was the president's name for it. Liberation Day has a big old chart that says, look at all these tariffs that people are putting on our goods, so we're going to tariff them back, and really spook the markets. It was a lot bigger, that sort of presentation of reciprocal tariffs, even though he'd signaled it, and the White House had signaled, hey, this is what we're thinking. The scale was higher than even the probably the most inside people were thinking. It was a much bigger bite at trade normalization than anyone had thought. So immediately what everyone sells, right? Think, recession, we're going to have trade wars. So the markets went bananas in April. And then a couple weeks into it, it's like, hey, wait a second, we're just going to pause on this while we make deals, right? And so that settled everybody down. So we went from about a 30% tariff rate back down to about a 20% tariff rate from basically 2, right? So we jacked it up to 30, come back down to 20, hang out at 20, and then we start making deals, right? So UK comes to the table, inked a deal with them, presumably reducing some tensions with our partners in Europe. Then we got China, so we made some progress in negotiation with China, cut back from 145% to something more normal, like 10. So big reductions, 30% in some cases, right? But ultimately, right now, where we stand at the sort of middle to end part of May, you're at about a 10% average tariff rate on everything, all goods coming into the United States. Sounds a lot better than 30 or 20, so I like that. It's also the highest level since 1946. So it's definitely different. It's a different environment to try to import into. So if you're buying things from overseas markets, Temu, or you're sourcing product from Chinese producers or Vietnamese producers or anything like that, bringing it in, you're experiencing a bit of a sticker shock, right, as you start to think through the rising prices. But some stuff hasn't really moved yet. It's kind of early in the game. We haven't seen all this come through inflation yet. We haven't seen producer price inflation start to tick up. So there's, I think, some pre-buying happened before the tariffs went on that are masking the real effects of some of these tariff levels. And we're going to learn a lot more in June, July, and into August as the delayed effects of some of these early tariffs start to show themselves in economic behavior.
I was going to say, and is there any kind of consensus as far as, do they think it was a high position to force negotiation? Where it's like, how much do you want? I want $10 billion. No. Okay, how about 100? You know what I mean? Like, where it's like, maybe 100,000. We'll go for that. And then people, is it more of that, or is it more of a looking at the economic shift of like everything went crazy, right? Like markets tanked. cats and dogs were living together. Like it's like everything went crazy for a second there, and then everyone kind of went, okay, wait, just kidding. It's hard to evaluate whether it was a negotiating tactic to bring people to the table, or it was like, oh, let's tap the brakes. But does it look like the conversations I think at this point it doesn't matter, but is it having an effect on negotiating is I guess what the question is.
There's a great article, I don't know if the Economist put it out or maybe Financial Times, but they were talking about how in game theory, your partners start to learn from your prior behaviors. And so some of the theories are like our counterparties in other countries, the trade negotiators are starting to look at the patterns that the president and his advisors are doing and learning how to respond and react to those actions. So absolutely, I think there's some game theory involved here. This posturing is certainly part of negotiation. If you've ever done, I'm sure you've negotiated before. There is a little bit of a psychological negotiating tactic.
Yeah, I want everything. No, I can't give you everything. Well, then tell me what you can give me.
Yeah. You ask for this knowing you're going to settle for this, right? Yes. Like you ask for more than you're willing to settle for. But I will say it's interesting to watch what happened with the UK negotiation. So we went to work with the United Kingdom, got some things taken off of lists and added to lists, and open up beef markets a little bit for U.S. producers, which is great. And ethanol, they're going to buy some ethanol from us, so all these things are good. But we left a 10% sort of floor tariff on there. So that tells me there's we're going to get some things, but maybe we're going to settle at a place that's higher than what we were used to, right? The 10%, we're not going back to maybe 1, 2, or 0%. Maybe there's going to be a higher floor than what we're used to. And that probably threw some of the negotiators off when they think like, oh, well, we'll just give them something and it'll go back to 0. Maybe that's not the move that this administration is going to take when people come to the table.
Is there, and this is all really perspective questions, but I mean, the intent behind this is to make it a little more painful to buy imported product and a little less painful to buy domestic. And of course, the quick solve to that, everyone reacts to the news headline like, yes. And then it's like, oh, wait, there's this whole, and you could say that for like, let's take car manufacturing, right? Like I could say I'm going to tax imported cars, but now everybody that is manufacturing parts internationally has to bring inside all the infrastructure of production and creation, like all of that supply chain networks. I mean, we're talking, some companies that takes like 10 years.
I know.
And so, maybe not immediate results, but the intent there is is that right? I mean, like that's kind of what we're building here. Like it's just we're tweaking it to where let's get some more manufacturing back in our country.
Yeah, I think that's one of the aims for sure. And you're exactly right. There's a long lead time. It took us 30 years to globalize the supply chain for everything, right? Everything's a global supply chain almost today. It took us 3 decades to really make that happen. And then we're trying to undo it in a couple of months, right? So it's unlikely, even during the first Trump administration, there was some reshoring of jobs, but there was also promises made and promises not kept about building manufacturing plants here. It could be semiconductors, it could be cars. But it wasn't exactly like manufacturing jobs were falling off of trees at the end of the first Trump administration. So I think it's part of the goal. The other part of the goal is probably raise a little bit of revenue. I think that's part of it as well. And some of it is maybe when I think about food, let's bring it back to agriculture.
Yeah.
There's some unfair practices, right? It's not the same to grow tomatoes in Florida as it is to grow them in Mexico. It's just there's a lot of differences in the input structures and the costs and all those things. And so we've seen some dumping happening in the vegetable markets in the U.S. and in some other fruit, categories in the United States in terms of food products. So part of it can be to sort of normalize those trade patterns and try to reduce some of the disparities in the cost of production across countries. Now, will that have its intended effects? Goes back to the exciting thing. Well, let's see, right? Let's see. Like theoretically, you're shifting the supply curve, and that should increase prices a little bit, but help local producers get a higher price for their good. Does it do it? And so that's one of those real-time experiments where we'll find out, do we see the same number of tomatoes, they're the same number of avocados coming into the United States from Mexico that we did pre, or is there some demand destruction from these foreign markets because, hey, it's just the price is too low. I can't get enough out of it, so I'm going to send them somewhere else.
Is there an element of this that, like, I mean, does it have to happen on some level where, and what I mean by that is there's multiple fronts of this administration where one of those focuses is immigration and agriculture being so heavily reliant on immigration, and, like, you know, to cut it to its most brutal elements, which I think my screen just froze out. That was weird. I think I'm back. With a lot of the ag market being dependent on, you know, immigration, and for the ugly part of that is you can underpay. Like, it's like they're not paid as much, and that's how we get food at a lower cost. Some of the tariff situation is driving up prices on imported food. You almost have to have that inflation on food prices to be able to support a more domestic work team. I mean, is there, I don't know. I feel like I know that's venturing into political territory or touchy, but it seems like a reality.
It's beyond labor. It's, you know, just think about the basics when you go to a Walmart. The basic goods have been price contained by our ability to move supply chains around the globe and take advantage of labor, wage, and technology disparities. So places that do things cheaper, we can now have those things cheaper as a consumer. And now I don't need a raise at work because, you know, my t-shirts haven't gotten any more expensive. Well, the underbelly of that is we're not making those t-shirts here, right? We're exporting that inflation to other countries, and we've enjoyed, you know, under 2% inflation for decades because of that supply chain globalization. Without that, you're pretty much stuck sort of absorbing the extra costs of making things here or doing things in a higher cost environment. Either capital costs more or labor costs more. So if you're going to make it here, it is going to cost the consumer more. And so, yeah, the consumer may have a job, right? You may have more jobs, but their cost of living is also going to go up a little bit. So I hate to say it's a lose-lose or a win-win, but that's the two sides of the coin. It's the yin and the yang of it. If you dislike globalization, you ignore the benefits of it, meaning that your grocery bill, your going back to school shopping, doing anything that enjoys goods, you're going to probably experience a little bit more inflation, especially if we keep a 10% floor on incoming tariffs.
There's about 50 rabbit holes I want to go down.
I know, right? How much time do we have? We can't.
I know you got the afternoon. Let's just do this. We'll Joe Rogan this thing and have a 4-hour podcast. No,
your producers will love it. They'll love cutting that up.
Exactly. Yes. Namely, that's usually me. So, no, I don't want that. All right, so let's steer this back into agriculture. Farmer Mac is going through their Q1 quarterly review of farmland values, which I think is a highly relevant topic. I'm sure that anybody listening sort of wants to dig into that. And then as we're recording this, I'm going to probably be dropping this here in, a couple of weeks. That will probably be released by then. So anybody listening, be sure to check this out. We'll have a link in the notes. But Jackson, kind of tell me, what you can, right? Since you haven't dropped that on the market yet, but also just kind of what you're seeing in terms of farmland values.
Yeah. Well, so what you're talking about, Mac, I'll just put a name to it, the Farmland Price Index. It's something that Farmer Mac released earlier this year, early in 25, for the first time, working with our partners over at Acre Value. We've worked with them for years. A fabulous piece of technology. We use all the land transactions that are happening around, so say like live sales right up until the quarter end. Mix that together with what we're seeing from Farmer Mac in terms of appraised values, lending levels, sort of real time information as they're happening. We mix it together with weights and do all sorts of statistical things to it. I'm sure Blaine Nelson, if he's listening to this, he's an economist on my team. He's probably like, you just said, just mix it together with statistics. Is that really is the technical term for it, rolling his eyes at me. But we mixed it together into an index, and we're able to launch a nationwide index of land values that tracks where things are trading sort of semi-real time. We've had that in housing for decades, right? The residential secondaries have been putting those out for a while. And there's like smatterings of those, like universities put out land value surveys. The USDA does an annual US, land value survey. And what we're trying to add to that is more frequency. So we'll release it every quarter, which hopefully helps your listeners. If you're listening out there and you're in the land markets, you can kind of get more of a real-time sense of how things are going. Are they trading up, down, or sideways? But we also want to make it based on transactions. So not surveys. Most data that you can get right now are off of surveys. I think NCREIF is one example that isn't survey-based. It's based on appraisals. But most of the releases that you can get publicly available are survey-based, where you just phone up, hey farmer, how much is your land worth? How much did it appreciate? Great intelligence, but I like transactions. They tell you a little bit of a different story. So now we offer a transaction-based approach to land value monitoring. Call it the Farmland Price Index FPI, powered by Acre Value, and our friends at Acre Value and CoStar really lent a huge hand in getting this off the ground. It's available through our website, so you can go to Farmer Mac. We put it out with our publication called The Feed, so you can check that out on Farmer Mac's website. And we're going to launch the Q1 in late May. So we're going to be putting out this data as you're listening to this. Go check it out. You can see what the Q1 values are. Spoiler alert, if you haven't clicked over there yet, land values are starting to level off, right? So we're seeing a bit of sideways movement in nationwide land values, and that's supported by you drill into any market. Some of them are up. You like cow country, right? So if you're in Oklahoma, Missouri, parts of Texas, where cattle prices have been sort of bringing a pretty fat premium, you see those land values pushing up. In places that are more crop centric, you see those prices starting to push down a little bit, just as lower corn, soybean, and wheat prices are processed by the marketplace and people start to move land. Supply has been coming up a little bit more. So all those things have pushed land values a little bit, putting some resistance on land values. And West Coast, it's a mixed bag, right? California, we're still dealing with some nut issues, right? So not enough water and too many nuts for so many times. So that's starting to work its way out. We've seen some leveling off in land values in California. And then you go up Pacific Northwest, it's kind of gangbusters. There's been a lot of good movement in land up in Washington, Oregon, Idaho. So it's a little bit of all over the place, depending on what market you're in. And all the drivers sort of make sense when you just break it down to supply-demand equilibrium.
I was going to say a lot of this right now is what it sounds like is being driven by the product of the land rather than the location of the land or marketplace for the land itself. It's the product that it's making. Is that kind of what you're seeing as far as it's not necessarily land values, it's what's that land doing?
Yeah, well, and who's doing it, right? So, I mean, what does a farmer like to do when they make a little bit of extra money? They're not going out and, sometimes they're buying fancy cars, right? But if they're thinking about their long-term wealth and the family, they don't put it in the stock market always. They don't put it in bonds, right? And then de-risk. They like to buy more land, right? That is a very common. You look at the auctions, right? You guys are running auctions. You probably see a lot of farmers are hanging out at those auctions or putting bids in. And in fact, in states like Iowa, you could see 90 or 95% of land purchases are in fact existing farmers or farming operations, right? So it's not, outside investors or new farmers always. It's typically farmers who've made a little bit of money and are putting it back to work by expanding their operations and buying up that 20 acres that never comes up for sale, or perhaps going north-south and diversifying their operations geographically. So there's lots of reasons why a farmer could do it. But to have the money, that means they had to have done somewhat well. And right now, who's doing well? It's the cattle producers. Okay. And honestly, the crop producers had several years where they were building cash reserves. So that's kind of carrying us through. And then I go to California. What was the problem there? Well, all of a sudden you had land that was fallowed legislatively because you had, maybe less water availability, water plans, all those sort of things to make sure we're not just slurping all the water out from under California. And all of a sudden people had to say, well, I can't grow anything on this. So it went from, 30,000 an acre to 10. And so that's the kind of shocks to the system that are causing a lot of those disparities. It's very much what do you grow on it? it's very much who's growing it and how has the cash been built up, right? If you have excess cash, you're going to see maybe land values start to see some upward momentum. If you're starting to see profitability pull back, you're probably going to see some downward momentum, and all that has to do with who's in the room buying the land.
What have we seen? You were talking about as you're building this index. So a two-part question. One part is, do you calculate inputs as an influence to the farmland index? And what have we seen with inputs over the last year? We had a period of time there where inputs spiked. I mean, it was a little almost unsustainable, right? The way that the inputs spiked. Where have we seen those head, and what is their influence, and sort of what do we see for the immediate future, I guess?
Yeah, well, so to answer the first question, the index does not take into consideration profitability or future. We're not trying to calculate the intrinsic value of a piece of land or overall land. We're looking at transactions. So what are people trading right now? So if you were to list a property, how much more do you think it'd be worth in a quarter? Or if you bought it last year, how much do you think it's appreciated? That's literally the intent of the index. But absolutely, what you've seen with input prices, particularly for crops, is a sort of a level shift the last few years. Very common when you have high commodity prices. Everybody wants a taste. Takes them a little bit of time to get, their products priced out. Maybe you've contracted your nutrients out a couple years, or you just refreshed your iron, so it takes you a few years to go back to, your favorite implement dealer and buy some new stuff. So it always takes a couple of years for those inputs to start to price in those higher commodity prices, and it takes a lot longer for them to leak out, right? So once the seed dealers have sort of captured a bit more of that profit margin, they're not wanting to cut their prices super quickly. So it tends to be, a couple years up and then 3, 4, 5 years to get back down. And in that time, what farmers do is they figure out how to do more with less, right? That's been my experience the last couple of times we've seen this. Farmers maybe pull back a little bit on some of their inputs, level off, maybe apply a little bit less, maybe pick different parts of the field, use different seed technologies, and really find a way to manage those costs rather than try to go negotiate a better rate or a better deal. So I still think we're in a little bit of a holding pattern on the input prices. One good piece of news is energy prices are way, 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 way down. We do have some, uncertainty around availability of nutrients, of fertilizers. We get a lot of fertilizer from Canada, so potash, right? And we got enough this year; it's no big deal. But as negotiations continue to go back and forth, maybe next year you could see a bit of a price pressure on some of our inputs, nutrients. Here in the cattle world or protein sector, though, hey, $4 corn, it looks pretty darn good to raise your crop, right? So if you're thinking about heartbeats and protein, your input prices are way, way down and your prices are holding steady. So that profit margin just keeps looking better and better. A year ago, I said, hey, cattle cycle, it'll start to pull. People will withhold, they'll start to build their herds again, and they still have not done it. People I talk to are like, yeah, I don't see the point, right? I'm going to rebuild my working capital. I'm going to use the cash to buy some additional land, maybe expand my herd next year, right? That's what I keep hearing. And I don't blame them because the money is pretty good right now and prices seem pretty firm. So make hay while the sun shines.
Right. And adjust as it gets there. So let's talk Big Beautiful Bill.
BBB.
I got to say, the new administration is making the naming conventions easier to talk about because they all have these headline titles. So Big Beautiful Bill is an easy one to remember and discuss. As of the last week, it cleared House this last week, and there has been some, should I call it, subtle nudging of encouragement to accept the bill. What are we looking at in it, and how do we anticipate this to influence agriculture?
Yeah, I totally agree with you on the naming. I looked at the name and I was like, I'm used to acronyms. I thought that was like Washington.
Terrible acronyms. They're always bad. Yeah.
So now we're off acronyms and we're just into splashy bill titles. Which, hey, I get it. You're a marketing person, right? There's
value.
Way better.
Yeah.
The big beautiful bill, yeah, it's like 1,000 pages. Reconciliation bill, it's huge. It includes a lot of stuff. They've worked a couple of farm bill things in there. There's like a smattering of things that are in there that I think are good for agriculture and ag lenders. In no particular order, I'll say, hey, raising the PLC prices, right? So your reference prices, that's in the bill. So going from a 380 to a 410 on corn, or moving soybeans to $10. Raising that price floor is incredibly important as you think about leveling up land values, creating safety nets for producers. All that's, we're talking about, hey, that's going to be in the farm bill. Well, maybe it happens a little bit earlier if the reconciliation bill happens. Same way with ARC, right? So the other program, we increased the coverage levels and pushed out how long we could keep those coverage levels. So, I mean, these are things that are pretty impactful to the day-to-day production or year-to-year production environment for a lot of producers, and they should be accretive to landholders as well, because that's really where you're tying together some of these programs. More deductions, so 199A or bonus depreciation and extending those for more years. So that's going to help. Hey, accountants, get ready, because you're gonna get a lot more calls and questions about that if it stays in. And then you got things like estate tax, so bumping up the level of estate tax and gift limits from, I think, 15 to 30 million, and then making it permanent part of law instead of sunsetting after so many years. So as farmers who are aging are thinking about that transition into the next generation, reducing some of those tax implications for that transfer of wealth and ownership, huge, right? So because that's going to maybe shake loose some of the land that's been locked up for people who don't want to do anything with it because they don't want to pay all that estate tax. Well, hey, now we're finding ways to maybe loosen up some of that land, which should help bring more supply. Maybe just another thing on the financing side. So there's a provision to give banks some interest rate relief from farm mortgage loans. So that's a really interesting thing that the banks have been promoting. Farmer Mac has been promoting as well to help lower the costs. So that would allow banks to deduct some of that loan payment. So as a farmer's making their loans, the bank doesn't have to pay as much taxes on that income, so they can lower their rates, right? And so that could be something really important for landowners and folks who are financing farms to lower rates, lower the costs, lower the capital costs, and help increase profitability across the farm financing spectrum. And there's also 45Z, so there's a lot of clean energy stuff. Some taking away, it's like it giveth and it taketh away. And I think 45Z is one where advanced biofuels, right? You think about SAF and some opportunities to build more demand for biofuels. Great, extending that for a few more years, giving some more juice to it, more incentives, taking away some of the things like EV credits and some of the solar project PTCs and ITC credits. So those are things that are sort of looking to sunset in the big, beautiful bill. So, I think on the energy side, you got some supports that I think are going to be accretive to farming operations, and some maybe take away some alternative income sources. So, bit of a balancing act in the clean energy space, but I like the 45Z. So like rethinking how we can provide support to things like sustainable aviation fuel, different biofuels, regenerative biofuels. So you think about, sort of clean diesels and those sorts of things, really important, impactful, can build a lot of demand for soybeans, a lot of demand for corn ethanol at a time when we maybe have a bit more corn and soybeans than we need. Hey, let's find some demand drivers. And it's all in the big, beautiful bill, the BBB.
I wanted to ask you really quick. You touched on price floors, and I was wondering if you could explain some of the good, the bad, and the ugly of establishing price floors in the first place, because there's arguments that you shouldn't artificially set that and it should be free market, and there's arguments that you should do that to establish a market. And I wanted to get some insight on that from your point of view. Yeah,
I mean, pure market economist me. So put my my true economist cap on. Agricultural markets are as almost as close to perfectly competitive markets as you can get. Like there's a lot of players. No one is a price setter. Everyone's kind of price takers. Everyone's rational. And I love all that because that means the rules of economics generally work. If you want to incentivize something, you can push on this. It's going to have the outcome that you wanted because the market is so competitive. So generally, economists don't like putting in floors and ceilings and caps because it artificially influences that sort of equilibrium price.
It's your anti-Ayn Rand kind of thing. That's
yeah, it's like let the invisible hand do its thing, right? I mean, that's the laissez-faire Adam Smith, economist view. But there's good reasons why you'd want to have supports, and most of it has to do with ensuring that you have a food supply, right? I always say food security is national security, and if you want to have an absolute uprising, you take away food. Look at any time a community lives without food, people rise up. There's usually turnover. There's unrest and war and all that stuff when you have famines. So there is I think it's important to support the industry. It's important to have good quality farming sector, and to do that, sometimes what you'll do is implement safety mechanisms. Crop insurance is probably another great safety mechanism that just totally distorts the production function. Like people will plant way more than they should because they have sort of those protections, and you de-risk that overproduction. But the other side of it is bad. If you had one bad year and you wiped out your entire farming sector, well, that's probably way worse than putting an artificial floor or market influencing dynamic into that supply-demand equilibrium. So I think the downside's way worse than being truly laissez-faire with our food. So I don't mind having some of those protections in there for producers so they can better manage those risks long-term.
That makes a lot of sense. You also touched on the Farm Bill, and I feel like this is one of these days we're going to have a really great conversation about what happened with the Farm Bill. But it seems like, because I mean, it's obvious there's parts of the Farm Bill that were really important because they put it into the big beautiful bill, like to your point. But this Farm Bill has been hanging out for I don't know how long. And it seems like it's the grenade that nobody wants to jump on, because invariably when they implement it, there's going to be some things that people don't like, and there's updates to the system that people are going to have to do, and they might not be politically beneficial.
Yeah.
Like, are they dodging this thing? Is it what's?
I think really smart people are working on it. It's a timing issue, right? So it just seems like every time there's momentum behind it, there's another political timeline that sort of interrupts that process. So trying to get some of the initiatives done in an earlier bill, I think clearly they're trying to get some of these things done. A lot of it's self-inflicted too. Like, why do we need a Farm Bill? Let's authorize some of these things more permanently. There's not every group and not every industry has to live with the amount of uncertainty that every 5 years we're coming back and relitigating what's good and what's bad for U.S. agriculture. So a little bit of it is just like, well, this is something that we like to do, to open up the box and kind of take a look at it. And that introduces uncertainty, right? So because we open up the box, now we all have to agree. And the great equalizer used to be SNAP program, right? So you have food stamps on one side. So if you take care of people with reduced cost food, you can then offset a little bit of, it's like everybody gets what they want kind of thing. Like, well, you give us some more money for giving food away, and we'll give you some more money, and we'll get behind supports for U.S. ag producers. For some reason, that's really broken down in the last 4 or 5 years. And that's one of the reasons why I think we've seen so many delays or not been able to get true consensus around a farm bill. But I think smart people are working on it. I don't think it's let's just kick the can indefinitely because we can. It's really, we got to put all of our effort behind this thing or that thing, or it's near the end of the year. We don't want to rush it. Let's give ourselves some wiggle room. And maybe farmers have been too profitable, right? So you look at farm income 21, 22, those are really strong profit years. So there was probably less motivation to put a lot of pens to paper when everything's going so good. But as you and I know, what the farm income number sometimes doesn't tell the full story. And so there's a lot of people struggling below that, hey, it's a record farm income in 22. Well, A, it's not anymore. And B, not everybody had a record year in 22. So I think it's a lot to juggle. I think they'll for sure get there. There's some things that are not in the BBB that need to get done, and the Farm Bill is going to get them to the end of the line. But the thing to watch there is like how many cuts come in SNAP. So BBB has some pretty aggressive cuts to the food support program. That might change the negotiating capabilities of Democrats and Republicans when we get to the Farm Bill after the big beautiful bill.
I think all of my outlooks on it were cynical, which tells a lot more about me than it does about the bill. I had it either as like maybe there's some things that they're discussing that are just going to be kind of pain points in an election cycle, and they'd probably just saying let the next guy decide this, or maybe it's it's the youngest kid in a family of 7 where like everybody else gets the attention and this one is just kind of like hanging out like, hey guys, so. But what you're saying is it's more of a negotiation impasse of like, okay, where is this going to affect this, and are you going to give on this because I'm not giving on this? There's a lot of that going on where they want balance in it, and there's going to be and it's just it comes down to that where it's like people have to get the right minds together to meet.
Yeah, I think that's a great way to think about it, as well as what's going on in the bigger picture. Hey, if nothing else was happening, we weren't doing tariffs and we weren't doing taxes, I think Farm Bill will be first up. But tariffs and taxes touch so much more of the economy that they're kind of getting a bit of a fast track with this administration. And the Farm Bill gets some showtime in the big beautiful bill, but it'll have to wait probably for prime time till after all of this gets settled.
Yeah, it's just not as exciting as tariffs and the big beautiful bill, like calling something the big beautiful bill. When
keep saying it.
They need a really fancy name for the Farm Bill to make it exciting, because it's going to be like, it hits the news cycle and there's a bill about cows. That's going to be the headlines behind it. But I think they just need a better title. They need better marketing in this thing.
Look, we're gonna take to social media and we're gonna put that poll out there. What should the Farm Bill be called?
I like it. I like that. Well, hey, I logged you for an hour, man, and you've got important things to do. So what I wanted to ask you is there anything that we didn't discuss that we should have in as far as the news cycle goes? I feel like we covered a lot.
We sure did. It's always a pleasure, Mac, to come on here because we get to just really take some left turns, and you do a fantastic job of pulling me, getting me to say stuff. So I appreciate that. I didn't talk about rates at all.
Okay.
So I will say, rates took a bit of a wild ride with the markets as well. But I think the Fed's pretty much holding steady, right? They're waiting to see what happens with all the data. So I say watch for rate changes in Q3, Q4. I don't anticipate huge moves. So, I don't anticipate 200 basis points up. Definitely don't anticipate 200 basis points down, but watch for some chop along the way. And the 10-year treasury is kind of the thing that impacts those long-term rates. So if you're thinking about purchasing land, refinancing land, if there's a good day where the U.S. treasuries take a dip, that's your shot, right? And it might be range bound between 4% and 5%. But if you can get that plus, 150 or 200 basis points, you got a pretty good deal. So I would say don't wait. I always tell people, know your numbers. When you see a good rate drop, don't think it's going to keep going. I know farmers love to wait for that price. The price is going to go up. It just went up 25 cents. I'm going to wait for it to go up another 25 cents. They do the exact same thing, Mac, on interest rates. And they're like, oh, it went down, 10 basis points. I'm going to wait till it goes another 10, and then it goes back up. And I missed it. So don't wait. It's going to be volatile, and you're going to have bites at that apple. So be ready to take the bite when the apple is ripe. I don't know. I didn't have a good way to finish that.
Yeah. They did kind of like an interest rate Bollinger Band kind of thing to get balance in there somewhere, to where it's what's the old build investment advice is the surest way to lose all of your money is to try to time the market.
Oh yeah, forget it. Can't do it. Make those capital decisions very rationally. Set a plan. Stick to the plan. You can do it just like your marketing plan.
Perfect. Sage advice. Jackson, thank you again. This has been great use of time for I think anybody who listens to this. I know I enjoy it very much. Thank you for giving us your time today.
Hey, it's a pleasure. And, hang in there. Hopefully this roller coaster, we get more screams of joy than screams of terror, right?
Interesting times.
Have a good one.
This concludes episode number 139 for the National Land Realty Podcast with Jackson Takach, Chief Economist and Director of Strategy, Research, and Analytics at Farmer Mac. You can learn more about land ownership and the buying and selling of land at nationalland.com. Be sure to subscribe to this podcast. We'll be coming at you fast and furious with more episodes, and we want to make sure that you don't miss any of those. So thank you again, and we'll see you next time.